Welcome back to FX Street. It's 2 p.m. Eastern, 12/12/2012. December 12th, 2012. Federal Reserve just met just very recently, about 12:15. 2 o'clock right now. Now, the Federal Reserve left interest rates unchanged as expected. And furthermore, we're going to go through the details of the Fed statement, but what's happening here is, okay, 12:15, they announced that they're leaving rates unchanged, and they announced a new asset purchase program that we're going to talk about, known as QE4. 2 p.m. right now, the Federal Reserve is releasing their projections, their economic projections, where specifically they believe the economy will be, and we're going to go through all that right now. And at 2:15, we're having a press conference. So it's 12:15, just about almost 2 hours ago, we had our statements. 2 o'clock right now, we have the actual projections that were just released. It's a lot of numbers. 2:15, in about 10-15 minutes from now, we're going to have a press conference. So expect the market to be, somewhat active. Not a really good time to place a trade if you're not already in a trade, because it's very hard to kind of gauge the direction of the market, what's going on. Okay, anyway, let's take this step by step. First of all, and by the way, my name's Adam Rosen. Very happy you could join us. We're going to start off with the quick, easy analysis that Bloomberg.com does for us. And then we're going to get into the meat and potatoes of this. Okay, so at 12:15 p.m. today, just a little while ago, Federal Reserve met. I'll chat these comments in as we go through them. Okay, so the Fed met, the Federal Open Market Committee, FOMC, met and left interest rates unchanged at 0 to 0.25% range. That was given. We all knew that was going to happen. Nobody expected anything other than that. Furthermore, the Federal Reserve said it will buy $45 billion a month of Treasury securities. Fed will buy $45 billion a month of Treasury securities. Moreover than that, Operation Twist will expire this month, as expected. That we knew. Okay. The current round of mortgage-backed securities purchases, which equals $40 billion a month, will continue. It's actually really, really interesting when you get into the details of what the Fed has done. Okay, so the Operation Twist, we said, will expire. Oh, and the last thing, the Fed will now base their decisions to strict economic levels. Okay. Let's take a step back. Number one, when the economy got into trouble, 2008, 2009, Federal Reserve, first thing they did, they cut interest rates down to 0. Usually, and that's what we normally consider monetary policy. Usually that's enough. In normal economic recessions, not a depression, but economic slowdowns, the Federal Reserve reduces interest rates. It makes it it provides more incentive to invest, because we're going to get less interest in a bank account or a CD or a bond. Those interest rates are all very low. So they lower interest rates in order to incentivize investment. It makes it less expensive to take a mortgage for a house, less expensive to buy an automobile, less expensive to invest in a company or to take our own money and to actually create a new company, do anything of the sort. Less expensive to go out there and take risk. That was not enough. Then we had the first stimulus program, TARP, Troubled Asset Relief Program. That was that $787 billion stimulus program that was put through 2008, 2009. That area of time. I think it was late '08. That was not enough. Then we had QE1, quantitative easing 1. Quantitative easing, by the way, quantitative easing, excuse my spelling here, involves when the Fed prints new money. I know this is a review for a lot of you. I know we talk about this almost every single webinar. Just in case anybody's not very familiar with the history of what the Fed's done, I think it's just kind of important to create a little bit of a, provide a little bit of a backdrop as far as what the Fed has done, the results, what they've decided to do now, today, and what we can possibly expect in the future. So bear with me. I know this is probably a review because we've all become economists over the past couple of years here. Okay, so the quantitative easing, the Federal Reserve prints new money and uses that money to stimulate the economy. They do that a couple different ways. They either buy long-term bonds. They buy long-term bonds, the bond price goes up, the bond yield goes down. The bond yields go down, and then stocks look more attractive. I mean, if I could buy a 5% bond, well, that's kind of good. But if I can only buy a 3% bond, why am I going to even, put my money in a 3% bond when I could buy stocks? What if the bond only pays 2%? Or 1%, then I really want to buy some stocks because they get 1%. It's not even keeping pace with inflation. In fact, and a lot of this is based around the inflation level. Consider inflation, 2, 2.5%, 3%. If you buy a bond right now, in fact, let's not guess. Let's actually you go to any website, USGG 10-year. That's the Bloomberg symbol for the 10-year bonds. And right now, the 10-year bond pays 1.68%. Well, where's inflation right now? Isn't inflation right around 2%? So if the price of goods and services is going up, is increasing at a rate of 2%, and a 10-year bond is only paying 1.68%, if I buy bonds, I'm actually losing money. So less of a reason, while interest rates continue to drop, to buy bonds. More of a reason to buy stocks or to invest in a company or buy a house or put our money somewhere out there in the economy, let it get to work. That's the reason the Fed is buying these bonds, because they want to make bonds less attractive. They want to make stocks and homes and investment and risk more attractive. The Fed wants us to take a risk, because when we take a risk, when we buy stocks or buy a house, everybody in the economy benefits in their own little way. So, Federal Reserve can use the money they print in quantitative easing to buy bonds, or treasury bonds, or a more targeted effect, a targeted program, something we call Operation Twist. Operation Twist, the Fed does not print new money, but rather sells short-term maturity bonds to buy long-term bonds. Okay. Operation Twist, which was enacted, I believe, at the beginning of this past year, about a year ago, was supposed to end in June. It was extended in June to expire in December this month. It will expire in December this month. As of just a few minutes ago, the Federal Reserve announced that it would. There's a couple different implications, and I apologize. I know this is kind of a review for some, but I think it's kind of important. What happened is we had quantitative easing 1, then we had quantitative easing 2. Quantitative easing 2 was huge. The Federal Reserve was buying $75 billion a month of long-term treasuries. It was an enormous, enormous program. Okay? Now, there's good and bad effects to any type of, sorry, that's supposed to be QE2, by the way. QE2, I had to shift you down. Okay. So there's good and bad things that happen with any type of macroeconomic monetary policy. The good news is the Federal Reserve prints more money, they buy the bonds, it keeps bond yields down, creates more incentive to buy stocks, and, well, we saw what happened. Take a look at the Dow Jones Industrial Average. I really wish I had the exact dates. In fact, let me get a clean chart over here. See if the Dow Jones Industrial Average. What happened was it really incentivized traders to get in there and to buy some stocks. And it worked. Quantitative easing 2 was in the year 2011. I cannot remember exactly when it started. It might have started 2010. I'm going to guess. It started at the beginning of 2011, but we know it ended June of 2011. It might have started earlier, actually. But we know for sure it expired. I think it was actually started some back in 2010. Okay? So we see here, this is the Dow Jones Industrial Average. Dow Jones Industrial Average experienced an enormous move up during QE2. Fed Reserve every single month, month after month, $75 billion a month of long-term bonds. Made bonds unattractive, made stocks very attractive. We can see what happened to the stock markets. Well, during the same period of time, we're printing all this new money. What happened when we printed this new money? All of our money, all of the dollars that I have in my bank account, lost buying power because there's more money out there. There's physically more dollars out there in circulation that my dollars have to compete with. So that created some sort of inflation. Inflation, we talk about gold. Quantitative easing led to inflation. Quantitative easing led to inflation. QE equals inflation in commodities because of the weakening U.S. dollar. QE2, or quantitative easing overall, QE2 in particular, this was a huge program, weakened the dollar. If you look at the dates, I don't have the exact dates of QE2, but if you look at the dates, you'll see the Dow Jones Industrial Average went up, gold went up, the dollar went down. In fact, let's try to do this. I'm approximating here. Let's say it was June of 2010 to June of 2011. I don't remember exactly the beginning dates. Okay, but that's a Dow Jones Industrial Average on the weekly chart. We're going to put this at the top. Let me know, by the way, if you can't see these. We're going to take a look at the dollar Swissy, which is over here. Weekly charts. Okay. And what do we say? June of 10 to June of 11? June of 10 to June of 11. Well, very easy to see the correlation there. Again, those lines highlight the dates of QE2 in terms of the dollar. That's easier to see, okay? Stocks go up, dollar goes down. When our dollars go down, when our dollars lose buying power, when we can afford to buy less bread, less milk, less oil, less everything, what do we buy to hedge to protect our falling dollar? We'll buy something like a commodity. There's no greater commodity buy than XAU, which is gold. Gold is a natural hedge against inflation. So again, we draw the same chart and we say approximately June of 2010, which is right around there, to June 2011. Use a daily chart in this case. Okay. All right. There we go. Okay, so you should see stock market, Dow Jones Industrial Average at the top, dollar Swissy in the middle, gold at the bottom. Quantitative easing, we expect this to happen. Well, a lot of congressmen started to complain to the Federal Reserve during their Beige Book meetings and their other regularly scheduled meetings. They said, listen, Chairman Bernanke, we love the fact that quantitative easing is making the stock market go up, but we can't deal with the inflation. The inflation is really hurting us. So, no more quantitative easing. QE2, it was a very, very strong program. It was almost too strong. There's unintended consequences to any one of these programs, and one of them was surging oil prices. Nobody wants to spend $150 on a barrel of light sweet crude oil or $5 for a gallon of gasoline just so that, to watch your stocks go up a little bit. So the Federal Reserve says, okay, well, we want to continue to keep interest rates low, and we have to do that without printing new money. So what do? Can we use operation? I just said the answer actually. Can we do another round of quantitative easing? No. we have to find something else. Let's think of something. Well, they came up with Operation Twist, which is actually a program they used a long time ago back in the 1960s, 61, I believe. Anyway, Operation Twist, as we said, they're not printing new money, so it's not leading to the inflation. They want to have their cake and eat it too, so to speak. They want to buy the bonds to keep interest rates as low as possible. But they don't want to print new money to buy the bonds. But how do you buy something without creating any new money? We have to sell something else. So the Federal Reserve says, well, we have these short-term bonds in our portfolio. Bonds with a maturity of anywhere from 6 months to, I think it's like 5 years, maybe a little bit less, maybe 6 months to 2 years. All of our short-term bonds, not all of them, but a lot of them, we're going to sell them. We're going to take that money, we're going to immediately buy long-term bonds. When you sell short-term bonds, short-term bond prices go down, yields go up. Long-term bonds, when you buy the bond price goes up, the yield goes down. So, in other words, Operation Twist, which was the substitute, what should have been QE3, but instead they chose Operation Twist. They're buying long-term bonds and selling short-term bonds, actually in equal amounts. So the size of the Fed's balance sheets, the economists, they use that term a lot. The balance sheet is all the bonds that they use. By the way, Ben Bernanke, chairman of the Federal Reserve, is starting this press conference right now. Now, there's intended and unintended consequences. On the good side, they say, great, we're buying the long-term bonds. We're able to keep interest rates as low as possible. Anybody who's thinking about buying a house, now's the time to do so. Let's go out there, let's put our money to work. And we're going to do so without creating excessive inflation, which means gasoline is not necessarily going to go up to $5 a barrel, or $5 a gallon, $150 a barrel. But there's unintended consequences also. What was the bad side of Operation Twist? Well, they're selling the short-term bonds. So short-term interest rates go up, while long-term rates go down. We'll say, well, who cares? That's okay, because we don't really trade bonds that much. But when you go to the primary sector in any industry, in any country, in any economy, we look at the banks. The economy will not recover if the banks do not recover, because the banks basically process our entire economy. If we want to take a loan to buy a car, if we want to get a loan to buy a house, if we want to invest in a business, if we want to do anything, we have to use money. Money goes through banks. And the easier or more difficult the bank allows it to be dictates on how much investment is going to take place. After all, with 2% interest rates, maybe now is a good time to buy a house. If interest rates were 3%, maybe not so much. 5%, definitely not. So interest rates matter. If you think about the bank's way that they make money, if I walk into a bank and I say, I want to take a loan, I want to buy a house, they're going to give me a long-term 30-year mortgage. 30-year mortgage is based on long-term interest rates. Well, that's good if long-term interest rates are low, which they are. But if I go in there and I want to open a savings account, I'm going to deposit my money in the savings account, and I'll be able to access that money at any time, so they can only afford to pay me short-term interest rates. So the bank is collecting long-term rates and paying out short-term rates. That's the bank's business model. Unfortunately, when long-term rates go down, the banks collect less revenue in mortgages. When short-term rates go up, they have to pay more to savings account holders. So, well, it kind of goes against the way that the banks make money. And that's not good either. So Operation Twist fell under a lot of criticism. Then we had earlier this year, we had October actually. Well, yeah, it was actually October. It was the October meeting. We had a Federal Reserve meeting, October 24th. This is the Federal Reserve meeting from October 24th. This is what they decided to do. Here's a link, by the way. Okay? All the way down, to support continued progress towards maximum employment price stability, the committee expects that a highly accommodative stance in monetary policy remain appropriate for a considerable amount of time after the economic recovery strengthens. Whoops, I went too far. Okay, here we go. To support a stronger economic recovery and to help ensure that inflation over time is at a rate more consistent with its dual mandate, the committee will continue purchasing additional agency mortgage-backed securities at a pace of $40 billion a month. The committee will also, through the end of the year, extend this program of average maturities, etc. Okay. So fast forward to October 2012. What happened? QE3. Well, first, we should make note. Operation Twist extended. Well, it already was extended, but it was confirmed to extend until the end of the year. Okay, that we knew already. Okay, that's when they talk about the committee will also continue through the end of the year its program to extend the average maturity of its holdings of Treasury securities. That's Operation Twist. All it means is they're selling short-term bonds, they're selling their 1-year bonds, and they're buying 30-year bonds. In addition, okay, so Operation Twist, that was about $45 billion a month. But that's going to end this month. Okay? Sorry, that was $45 billion. What did I write? $45 billion. Okay. In addition, they're going to buy QE3. They're going to buy $40 billion a month of mortgage-backed securities because the Federal Reserve said, you know what? We understand that the housing sector is one of the weakest sectors in the market. I would actually disagree. The housing sector has probably been one of the strongest sectors this year, 2012, in the market. I would say retail stocks have maybe, the retail sector has maybe been one of the weaker ones, or maybe the banking sector. Actually not necessarily, I take that back. The banks have been strong too. But the banks in the housing market, all put that aside, the Federal Reserve says we need to help the housing market. Because if the housing market comes back, the banking sector is going to come back, the entire economy is going to come back. So this is what we have to do. We're not going to buy long-term treasury bonds. We're going to do something a little bit more targeted. It's more of a targeted, planned way to fix the economy. We're going to buy mortgage-backed securities. When I walk into a bank and I take a mortgage for a house, and let's say I foreclose on a house, I run away from the mortgage. Now the bank takes back the house. And the banks don't want to own homes. They want to keep money. Banks work with money, not homes. So they have this bad debt. It's called toxic debt. They have to get rid of it somehow. The Federal Reserve has told the banks through this QE3 program, we're going to buy that toxic debt away from you. Don't worry. You're actually in a much better position than you thought you were. Because we're going to buy back this toxic debt away from you, mortgage-backed securities. You basically package all these bad loans into one little package. Federal Reserve buys it away, and the bank is left with all the good loans. The bank is left with only the customers who continue to pay their mortgages. That's beautiful. That was QE3. $40 billion mortgage-backed securities, $45 billion Operation Twist. QE3, total of $85 billion a month. Okay? Fast forward till today. What have they done? Well, Operation Twist is over. Okay? QE4 is announced, which was just announced. And this is today's statement, by the way. December 12/2012. It's the last time of the century that's going to happen, by the way. Okay. To support a stronger economic recovery and to help ensure that inflation over time is at the rate more consistent with its dual mandate, the committee will continue purchasing agency mortgage-backed securities at a pace of $40 billion a month. The committee will also, Operation Twist, QE3 extended. The committee will also purchase longer-term Treasury securities after its program to extend the average maturity of its security holdings for an initial pace of $45 billion a month. This is actually they're swinging a big stick with QE4. This is why. Think what we had before. Just last month, October, they had a program of $85 billion a month. Half was Operation Twist. The other half, $40 billion. It's either both halves. Each half was about $40 billion, 40 or 45. It's around 40. $5 billion between friends. It's fine. Okay. So Total of $85 billion a month. Half of it was Operation Twist, which was not inflationary, because remember, Operation Twist, you're selling short-term bonds to buy the long-term bonds, so it doesn't create any inflation like oil and gold. The other half was QE3, but they weren't buying straight bonds, long-term treasury bonds. They were buying mortgage-backed securities. They're buying the toxic debt away from the banks. To tell the banks, don't worry, it's okay, go out there, lend. Okay, QE4. What we have now, QE4 is actually QE3 plus QE4, if that makes any sense. QE4, which is what we have today, quantitative easing 4, equals QE3 plus QE4. What does that mean? It means that QE3 has continued. They're going to extend the current program of buying $40 billion a month of mortgage-backed securities. That's what they said right here. To support a stronger economic recovery and to help ensure that inflation over time is at the rate more consistent with its dual mandate, the committee will continue to purchase additional mortgage-backed securities based on $40 billion a month. That's QE3. This is QE3 continued. So, I'm staying corrected. QE4, I'm making a big deal out of this, equals QE3 extended plus new QE4. So they're going to extend QE3. They're going to print $40 billion a month of new money. It's going to come from the sky. I don't know where it's going to come from the printing presses. And they're going to buy $40 billion a month of mortgage-backed securities. So what does this tell me? I like the housing market. And I like the banking stocks. I think those are two sectors in the U.S. economy. In 2012 they were strong. I think in 2013 they could also be quite strong as well. I mean, you don't have to look any further than look at a stock chart of some banking stocks or home builder stocks. Now I know that these stocks are well off their 2007 highs. Yahoo Finance. But if you take a look at the chart over the past couple of years, it actually tells quite a different story. Take a look at a stock like Toll Brothers. TOL is a symbol. Now, we can look at a 5-year chart. Well, actually, first we look at a maximum chart. This is Yahoo Finance. We'd say, well, Toll Brothers is $31 a share. But that was after hitting highs of near 60, back in 2005. That's not so good. But over the past 2 years, if you would have bought Toll Brothers the beginning of the year, you would have paid somewhere around $20 a share. It's 31 now. 50% return. Double if you bought at the bottom of last year. And you look at any other of these symbols. BZH is another one. Here's another 2-year chart. BZH is $14 a share. That's not really a big deal. But over the past couple of years, 2 years, BZH was as low as 7. So it was a double off of its low. Another one, Hovanian, HOV. These are all home builder stocks. $5.53 a share. Well, that's not very good, except for the fact that if you would take into consideration, if you would have bought HOV when QE2 was in full-fledged, you would have paid about $1 a share. It's now $5 a share. So whatever the Federal Reserve is doing now, it is, in some way, it is working. It's working in the housing market. It's working also, I didn't even look at these stocks. I hope I'm not wrong. But here's Citigroup, $37 a share. What's good for the home builders is good for the stock, good for the banks. But if you would have bought it during QE2, you would have paid $25. It's now $37. That's about a 50% return right there. So I think that based on today's program, today's announcement, I think banks and housing stocks, I think, at least from a fundamental perspective, there is promise. Now, what the stock market actually does, if there's some sort of other event, the fiscal cliff, we're only talking about one little piece of the puzzle. Okay? This is one little piece. Okay, so we have the Federal Reserve extending its QE3 program, but now it introduced a brand new QE4. What is QE4? QE4 is, go back to the Fed statement, which is, that's October. Here's November. December. Okay? Okay, so, Okay, so we know about the $40 billion a month of mortgage-backed securities. The committee will also purchase longer-term Treasury securities after its program to extend the maturity of its holdings in the Treasury securities complete at the end of the year, initially at a pace of $45 billion a month. They're purchasing longer-term Treasury securities after, okay. So they're saying after Operation Twist, that's over, but that was not enough. QE4 equals $45 billion a month of long-term, of buying long-term treasuries for a total of $85 billion a month. Now think of the inflation a month, $85 billion a month it's supposed to be. QE2, we all know what happened, and this is why I want to identify what happened during QE2. QE2, I forget exactly when it started, but we'll take a look at the chart from June of 2010 to June of 2011. The Dow Jones Industrial Average went from levels around 9,500 up to about 12, almost 13,000, 12,600. The dollar Swissy, because remember, we're printing new money that decreases the value, it dilutes the value of the dollar. The dollar Swissy, the beginning of QE2 was $1.10 to a Swissy. By the time QE2 was over, the dollar Swissy was 9,200. Couple thousand pips on the dollar Swissy. Well, when the dollar goes down, we want to buy gold. Gold, if you bought an ounce of gold in the beginning of QE2, you would have paid around $1,200 an ounce. By the time QE2 was over, you could have sold that ounce of gold for $1,500. You would have made $300 on a $1,200 investment, which is about what? 25% return. Gold went up 25%, no margin, just 25% straight return on your money during QE2. Remember, QE2, and it was led to a lot of inflation. QE2 equaled $75 billion a month. And there was no Operation Twist. It was just straight, let's print money and buy bonds. Print more money, buy bonds. How much are we printing? $75 billion a month. Well, guess what? What do we have today? We have $40 billion a month of mortgage-backed securities. We're going to print that money. And we have another $45 billion a month of new QE4 announced 2 hours ago. So today's program, the program that was announced today, is actually even a little bit bigger than QE2. So if the Dow Jones Industrial Average went up several thousand points, if the dollar Swissy went down several thousand pips, if the price of gold went up 25% on a non-leveraged basis, logic dictates that if we see QE4, we might see a similar effect. Now, I'll back up. I happen not to believe that we're going to see the same kind of returns. I really don't think we're going to see the stock market go up another 3,000 points. I think the dollar Swissy has a good chance to go down. I don't know if we're going to see thousands of pips at the downside. Gold, will it go from $1,700 an ounce to $2,000 an ounce? I don't think so. The reason why I think that even though QE4 is actually even a little bit bigger than QE2 is very simply because the market prices in these things. You know, QE2, none of us really knew. I mean, QE1, it wasn't that big. I wasn't really kind of paying attention at the time. I said, yeah, I know gold's going up. It's the macro trend. I know the dollar's going down. Nobody wants to buy the dollar, you know. But I think that we all collectively, as far as traders and economists were concerned, we didn't really understand as well as we do now the impact of printing new money to the dollar. And the dollar goes down and gold goes up, and specifically Operation Twist. So there's always a little case of buying a rumor, selling the news. Some of the price of gold right now, and this is why I have a problem with, all of a sudden you hear the gold experts that come in now and they tell you to buy gold at $1,700 an ounce. Well, I happen to think that gold has a good chance to go up. But I don't know. I think that the big move has already occurred in the price of gold. Because now we're all talking about gold. I mean, if you want to find a good investment, you have to find an investment that nobody's talking about. You have to find Apple computer stock before anybody was talking about Apple. Now that, the iPhone 7 is going to come, or the iPhone 5 is coming out, or has come out, a lot of that success has already been factored into the price of Apple stock or the price of gold. Not to say that QE4 won't push gold higher. I don't think it's the same kind of investment though anymore. So again, to reiterate, on just analyzing what we're looking at in terms of QE4, it's pretty aggressive. When we had QE3, I said, well, half of it's Operation Twist. So that means half of the program is non-inflationary. It's kind of like a diet QE. In fact, I remember actually during our October webinar, Fed webinar, I actually think I said that. I said, yeah, QE3, it's kind of like a diet. Does anybody here remember if I said that? I think I did. I said QE3 kind of looks like a diet QE3. Because half of it, it's Operation Twist. And the other half, they're not even buying longer-term treasuries. They're only buying mortgage-backed securities. So it's not really, it's not as powerful as what we saw in QE2. That was actually kind of let down a little bit. Maybe that's why the stock market has been wavering lately. Maybe that's why the dollar's been a little bit stronger. But QE4, this is no joke. I mean, at least according to what they're saying right now. Now, here's the other twist. As if that was not enough. In the old days, the Federal Reserve would meet, and this is from the October statement, all right? This is in the old days. The old days is October 2012. That's how current we are with our analysis. When we look back at October and we say those are the old days. In October, at the end of the statement, the last paragraph or the second to last paragraph, they said to support continued progress towards maximum employment and price stability, the committee expects that a highly accommodative stance of monetary policy will remain appropriate for a considerable time after the economic recovery strengthens. In particular, the committee also decided today to keep the target rate for the federal funds rate at 0 to 0.25%, and currently anticipates low levels of the Fed funds rate likely to be warranted at least through mid-2015. Okay. But my point being, I guess I didn't have to read that whole thing. When did the Federal Reserve say they were going to end QE3? They said the committee expects that a highly accommodative stance will remain appropriate for considerable time. When? For a considerable time. After the economic recovery strengthens. They're not mentioning any specific dates. They're not telling us that QE3 is going to end in December or June or July. They said until things get better. How better? Significantly better. What was the words they said? Appropriate for considerable time after the recovery strengthens. So what does it mean? Until I get a job? Until you get a job? Does everybody have to get a job? Does unemployment have to fall? How much does it fall? We don't know. Now, today's statements, they've given us a lot more specificity. They're a lot more specific. Okay, the committee decides this from today. The committee decided to keep the target rate for the Fed funds at 0 to 0.25%, and currently anticipates that this exceptionally low rate range for the Fed funds rate will be appropriate at least for as long as the unemployment rate remains above 6.5% and inflation between 1 and 2 years ahead of its projected no more than 0.5% of its 2% longer run goal. Okay. To say this in an easy way, the Fed has said this will continue as long as unemployment is greater than 6.5% and inflation below 2.00%. Now they are a lot more specific in their targets. Now the Fed has said, QE4, which is actually even a little bit bigger than QE3, guess what? We're serious. We're leaving our foot on the gas. We're leaving everything on the table until things get a lot better. How much better? Unemployment below 6.5%. Inflation has to be above, that's inflation. Unemployment, I did that opposite. Unemployment has to be less than 6.5%, and inflation has to be above 2.00%. That's how it should be. That's what the Fed said. I have a problem with this. Now, I mean, this is good for traders. For you and I, now we have some real information to trade on. Because guess what happens? Next month when the non-farm payroll numbers release and the unemployment rate, which is currently, I forget, 7.7, 7.8%, now, if it's expected to drop to 7.6%, and what happens if the unemployment rate goes up to 7.9, it goes back up to 8%? What happens? You want to really make things complicated. What happens if the fiscal cliff situation is not resolved and that we fall into another recession? A recession is when 2 consecutive quarters of real GDP is below zero. What happens if unemployment goes back up to 11%? Well, all the traders are saying, well, QE4, that's going to last for a long time. We might have another 2 years of QE4. Maybe we'll have QE5 and QE6 and QE7. We're going to have so much stimulus, we're not going to know what to do with all the money. What will happen to stocks? I think you'll have a super stock markets. The irony is, the worse the news it gets, the better stocks could do. And the worse the news gets, the more we're going to sell the dollar, because guess what? I don't want to own dollars if I think the Federal Reserve is going to print another $85 billion a month of new money every single month. And when next month's unemployment level comes out at 10.5%, I'm sure it's not going to, but if it did, guess how long we're going to have QE4? For a very, very long time. How about gold? If gold went up $300 an ounce during QE2, and the economic numbers get so bad next year, if we fall off this fiscal cliff, taking the pessimistic side of the coin, will gold go up? Well, there's a good reason for gold to go up if I expect the dollar to go down. Now, I have a problem with this, and I really don't like setting time limits, specific expiration dates on monetary policy, because the reason why we have monetary policy is to stimulate the economy. Now, I'll go on record. I don't think any of this is a good idea. Quantitative easing, monetary policy, I think it's too much. I think that the answer lies in fiscal policy. If you want to fix the situation, you've got to fix taxes and regulation, but that's a different conversation. Nevertheless, we have now this super monetary policy. I mean, $85 billion a month. This is following, 50 years. I don't remember the last time. I honestly don't know if we ever had this amount of aggressive monetary policy before. We had Operation Twist back in the 1960s, but as far back as I can recall, we've never seen something like this. So we have to watch the economic numbers very carefully. And the economists, every single month, you go on the calendars, the economic calendars, and they'll say, well, next month unemployment is expected to fall from 7.7 to 7.6%. And if it comes in better than expected, even we could start to trade off the initial jobless claims and say, well, if the initial jobless claims are worse than expected because of Hurricane Sandy, that means the unemployment level is going to be worse than expected, and therefore sell the dollar, buy gold, buy stocks, etc. And conversely, if the news gets better, if unemployment next month comes down to 7.5% and then CPI goes up to 2.5%, that's inflation, well, then there's reason to believe that the stock market might actually go down. Because good news means less monetary policy, less quantitative easing. Good news could mean a stronger dollar, higher interest rates sooner than expected, weaker gold, etc. So I think you can kind of see where I'm going, that I think that now they've set specific parameters for the unemployment level and inflation, now we can begin to find trades off of these numbers from a fundamental point of view. Now, I know I'm running short on time, but I'll say this. What I don't like about what they've done is this. They've tied the monetary policy, they've created a linkage between monetary policy and the unemployment rate. Is the unemployment rate really that representative of the state of a state of employment in the U.S.? I would say not really. Because the unemployment rate counts the amount of people that are not working full-time, that are still looking for work, that are actively looking for work. It doesn't count those people that are part-time employed. It doesn't count those people that have just been so discouraged that they've basically given up and they're not working anymore. And we say, well, we have a much greater amount of entitlements for jobless claims jobless benefits, etc., that it's actually a lot easier to be unemployed. Now, it's a horrible thing to be unemployed, but it's easier to be unemployed now that we have 99 weeks of unemployment insurance available. In the old days, you used to get 4 weeks. Now we have 99. So you literally could have an individual unemployed for 2 years, and that person is no longer counted in the unemployment rate. So if the unemployment rate falls, which it did last report, if I'm not mistaken, did that mean that more people actually got back to work? Not necessarily. More people did not get back to work. In fact, what we're looking at is less people got back to work, and less people are now looking for work. In addition, it doesn't count those people who have part-time employment. Part-time employment, less than 32 or 35 hours a week, means you don't get insurance, you don't get 401k, retirement plans, so they're not really fully back in the economy, participating in the economy. They're making probably just enough to get by. A more representative figure of the unemployment situation in the U.S. is the participation rates. The participation rate measures labor force participation rate are the employed and the unemployed but looking for a job. It differs a little bit, but the participation rate is much, much worse. You have to kind of look into it, but it's it indicates that the economy is actually in a much worse state than the unemployment level. Furthermore, I would say this, it's a little bit of a pet peeve with me, that you look at the economic calendar and say, well, non-farm payroll, everybody knows non-farm payroll. Non-farm payroll, we're expecting 100,000 new jobs were created this month. And that's, the actual number was, I forget, I'm making this up, but the actual number is 150,000. And most people say, that's great. We're expecting 100,000 new jobs would be created in a month of, whatever. And 150 were actually created. That's better than expected. That means the economy is going better than expected. No. 150 is still a bad number. Because I remember from the old days, in order for the economy just to maintain pace with the amount of people that are retiring every single day, you have this entire generation of baby boomers, they're retiring every single day. There's thousands, or there's some kind of figure out there, tens of thousands of people every single day retire. We need at least, I remember the number was somewhere between 300,000 to 400,000 jobs a month. Non-farm payrolls needs to be between 300 to 400 a month just to maintain pace with all of those people that are unemployed. That are retiring. McDonald's, I remember hearing this statistic recently. McDonald's hires around 50,000 people every month. So if non-farm payroll is 100,000 jobs and 100,000 new jobs have been created every month, well, 50, that means that McDonald's hired 50, and then maybe Wendy's and Burger King hired some more. That means really there wasn't that much employment. 100,000, even if it beats 150,000, even if it beats expectations, it's still not a good number. Every single month we have a number of less than 300,000 or 400,000. That's bad. And in addition, the Federal Reserve, they've also tied this to the inflation rate, which they say is 2.0%. But they're not using the CPI. When we all took economics classes, we learned about the CPI being the representative number of inflation, consumer price index. It measures the basket of goods and services at the consumer level. When prices for goods and services go up, that's the CPI, then the CPI goes up. And when the prices go down, the CPI goes down as well. Federal Reserve says, no, we're not using the CPI anymore. We're using something new. We just invented it this year. It's called the PCE. I don't know, but it's a new number. Personal consumption expenditure. Personal consumption expenditure does the job of the CPI, but it's a little bit different. You have to kind of Google around to find a definition. There's differences. One difference is the weight that it gives to the housing markets. And also, this is what I heard an analyst talk about one time. I don't testify for this being 100% accurate. I believe it is, though. That the PCE allows for substitution. Substitution means a couple of years ago when we were all making a lot more money, we would go out to a restaurant, the most expensive restaurant, we would order the most expensive steak dinner. Well, when the economy went down, we ordered less of those expensive dinners, and the CPI would have gone down. The PCE, personal consumption expenditure, understands that the economy is bad, so we say the PCE says it's okay. If you go to another restaurant and you order a steak, but it's not as expensive, you go to a lower quality restaurant, it's still going to count as a steak. That a steak is a steak is a steak, but that's not really representative of our economy. I mean, after all, when we're making good money, we go to good restaurants. When we're not making good money, we don't go to good restaurants. At least we shouldn't. So the PCE allows for that substitution. So it doesn't really fully reflect the state of the economy. It understands that the economy is bad, but I don't want an economic number that understands what the economy, how the economy is doing. I want an economic number that's completely unbiased. That if the economy is bad, then the line goes down. The economy is good, the line goes up. So, and I know I'm running really short on time here. So we've had a couple really interesting developments. What does this all mean for us today? Well, first of all, QE4 looks like it's even bigger than QE2. No more Operation Twist. It's a fully inflationary type of event, which means I would not be surprised to see stronger stock prices, a weaker dollar, stronger commodity prices, gold, silver, oil, etc., higher food prices, pizza's going to get more expensive. And I think there's carry trade currency pairs, Aussie yen, Aussie dollar, Kiwi yen, Kiwi dollar, high yielding currencies versus low yielding currencies. I think those will continue to show strength. The trend is your friend. They've been strong lately. You have to look no further than a Kiwi yen monthly chart. If you haven't looked recently, it's unbelievable how strong this chart has been. I think today is, there we go, no difference. No reason to believe that this trend is going to stop. Now, that's a Kiwi yen monthly chart. Kiwi yen today just broke to levels we've not seen since October 2008. Is the economy really that good that it's better than the past 4 years? I would argue no. But this is an economy. These are financial markets that are under very, very strong, heavy influence of monetary policy. We're not here to judge whether it's a right or wrong thing. I mean, I'll be happy to tell you what I think. But as traders, it's better that we only anticipate the most logical outcome. And I expect these current trends to continue based on this monetary policy. Now, this does not take into consideration fiscal cliff, Congress. The S&P, they downgraded. Remember this, the fiscal cliff into June of 2011? Well, that led to the S&P downgrade of the U.S. AAA credit rating that went down to AA+. We're not talking about any of that, and all of that plays a very important role. So please be aware that we're looking at the economy only through the very, very small prism of monetary policy and the developments that we've learned today. There's a lot more to it. The next huge event, probably, I'm guessing, 11:59 and 59 seconds, right before New Year's Eve, Congress, at the last possible moment, will come together with some sort of idea, some sort of plan that's put together with duct tape, where they're going to say, well, these taxes are going to go up, and this spending is going to go down, and we're going to do this, or we're not going to do that, and that's what's going to happen. And any surprise, I think most people are somewhat cynical, not thinking that any great development is going to take place, but most people are expecting some sort of development. I'll say this right now, I'm very, very suspicious that S&P, Standard & Poor's, Moody's, any one of those, they could downgrade U.S. credit rating again. Not necessarily because the U.S. economy is so bad, but because all we do when we turn on the TV, is to see the politicians fail to agree. And that was the reason why the U.S. credit rating was downgraded June of last year, actually August of last year. It wasn't because our economy was so bad. It was because Standard & Poor's, a credit rating agency, had very little confidence in our political process that we would be able to, find a solution. So I would ask you, do you think the political process is any better now? Do you think that they can agree any more now than they were able to in August of 2011? I would say not. So please be aware of that. That is, one very potential large speed bump along the way. Unfortunately, I'm out of time. If you have any questions, you can contact me directly, www.forexknowledge.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see their calendar because we have a lot more to talk about before all this is done. Again, we thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside FX Streets.